Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we are following out of the BNN Bloomberg newsroom. The Bank of Canada kept its main interest rate unchanged at 2.25% and says it's going to look through the Iran war's immediate impact on inflation. The governor, Tiff Macklem, says a rate cut may be needed should the U.S. impose significant new trade restrictions, adding inflation is expected to peak at about 3% this month. The central bank also slightly revised upward growth forecast to 1.2% for the year, 1.6% for 2027. CGI is the worst performing stock on the TSX today. Revenue for the IT and business consulting firm came in below estimates in its latest quarter, while profit was in line with expectations. The company's bookings also fell by a little over $150 million. Now, on the upside, CGI did see revenue grow annually on favorable foreign exchange and credited its performance to its AI-first strategy and clients' continued investment. Aecon Group, one of the best performing stocks on the TSX today after the engineering and construction company beat expectations for first quarter revenue, which grew 18% compared to the year before. The Toronto-based firm also posted a record backlog of almost $11 billion. Aecon says it expects 26 returns to rise further, driven by growth in new markets, recurring revenue programs, and strong opportunities in power generation and also defense. The TSX Composite down today, 305 points or almost 1% to 33,278 this hour. South of the border, markets also in the red. Not a significant move for the S&P, but the Dow is down 0.7% or 337 points, and not a material move today for the Nasdaq. It is down 5 points on the day. So a lot of things for investors to chew on, including the Bank of Canada and the U.S. Federal Reserve keeping interest rates unchanged. There is also a jump in oil prices and a tech sector blockbuster still to come after the end of the day. 4 of the world's biggest companies report earnings. Let's go to Josh Shelluck on this, portfolio manager at Verican Capital Management. Josh, obviously a lot to go on. Let's start with the Bank of Canada and the U.S. Fed leaving rates unchanged. That was expected. But were there similarities and differences you took away?
Yeah, I think the idea of uncertainty and unpredictability is certainly influencing both of their decisions, and you can see that in how they're guiding forward. In the U.S. especially, you could see a bit more dissension and dispersion in the path forward that the governors are projecting than there has been in the past. So I think you're seeing reflected in both sides of the border a degree of uncertainty that's a little bit unusual from where we've been in recent times.
Okay, let's get to Brent crude being up. Last time I looked in the $119 US range. No sign that the conflict in Iran is going to abate. What do you think this means for Canadian investors and the TSX?
Well, on the one hand, for the TSX, it should be quite positive because of how much energy exposure the index has. And if Canadian investors are highly exposed to the TSX index, then they should see some of those tailwinds come from that energy sector exposure. But more broadly, high energy prices are a challenge and not a great thing for economies worldwide. So you kind of have a bit of a push and a pull. On the one hand, a bit positive, given that we're such a resource-centric economy and a resource-centric stock market especially. But on the other hand, probably a little bit of a negative. And I think eventually that economic impact is probably going to outweigh the single sector exposure that we have for the energy sector here in Canada.
All right, let's get to the news that the UAE, the United Arab Emirates, is leaving OPEC. What do you think that means for prices for oil in the near term? And are there any concerns at this point that the cartel will collapse?
Yeah, it's hard to say in the near term exactly what it's going to mean. I think on the surface, the knee-jerk reaction would be that this is probably puts a little bit of downward pressure on the price of oil, but we're certainly not seeing that today. And that tells you that no matter what happens, the conflict with Iran is probably going to dominate the direction of oil for the next little while anyway. The prospect of OPEC collapsing, that would be anybody's guess. I'm sure there's a lot more plugged in political people than me that can weigh in on that. So I think it does show you that maybe OPEC's influence is weakening. I think it has been weakening for a while, and that's just a function of the U.S. becoming such a dominant producer of oil worldwide. Now, almost, I would say that the U.S. is the swing producer of oil globally. They are now a net exporter of oil. The advent of shale has significantly changed the economics around the U.S. energy sector. So I think all of those things have contributed to OPEC's influence becoming a little bit weaker. And then throw in on top of that the world in general, the global economy is a lot less energy intensive today than it has been at the past. And maybe we're a little bit less at the mercy of OPEC than we have been historically. So when you hear about the UAE talking about forging different political alliances than it has in the past, I think all of those things come to say that maybe OPEC is going to have a little bit less influence or less power than it has historically.
All right, let's get to the big mega tech companies reporting after the bell. There are four powerhouses that will report earnings. What do you think investors should be looking for?
Well, I think there's a couple things that we're looking for. The first is revenue growth, and the second is free cash flow. And I think we're obviously going to see strong revenue growth out of them. We've been seeing strong revenue growth for a long time out of these companies, but how strong? And are we starting to see strong revenue growth in the areas that are specific to the AI build out? Because we know that they're spending hundreds of billions of dollars on CapEx for this AI build out. Are we going to see the returns on that investment that we need to see to maintain the lofty valuations and lofty prices that we see? And to be able to see not only the revenue growth, but the free cash flow growth and the free cash flow generation being there behind this massive CapEx spend, I think is extremely important. What we're seeing for these companies in our mind, I think one of the things that's not being emphasized enough with these companies is that they're transitioning from being very capital light, very high margin businesses. They've been that way for a long time, some of the most dominant businesses we've ever seen in the history of the planet. And they're moving to a more capital intense, higher capital spend type of business model that could pressure margins. It's already pressuring ROEs a little bit. And so we'll see how that plays out over the medium term and whether they can turn that dominant market position back into something that's going to really support the valuations of those businesses, because despite their size and their high growth, they are still valued at a fairly lofty level.
Okay, given everything that's going on, what is your investment strategy right now?
Well, staying diversified, it's kind of a tenet of ours. It's always going to be a strategy that I talk about when I'm on here. I think it's extremely important right now because we have, as we talked about throughout all of this, there's a lot of uncertainty going on in the world, not only with the war in Iran, but with the tech earnings, the tech results, and where leadership is trending in the world. It was not a very tech-favorable environment for the first 3 months of this year, but all of a sudden it's a very tech-favored environment again, with technology doing extremely well over the month of April. So that changing leadership has meant that Canada has led for parts of this year, but also the U.S. has led in terms of the stock market for parts of this year. It's meant that the tech sector, commodities have led for part of this year. So that changing leadership is, and we're talking about months at a time, very hard to predict. And our suggestion would be don't try to predict this. Have some exposure to all of these areas. Have exposure to different types of investments that are going to be successful in different types of futures, different types of environments, war, no war, high inflation, low inflation, AI spend, no AI spend, and that's what's going to help you be successful.
Let's leave it there then. Josh, thanks for joining us today. Appreciate it.
Thank you.
Coming up next, what is the roadmap for the U.S. Federal Reserve? It keeps the interest rate unchanged. We'll get into that expert analysis when we come back. The U.S. Federal Reserve gearing up for a transition at the top, left interest rates today unchanged. And Jerome Powell said he would continue as a Fed governor after his term ends next month. Let's go to Bruce Kassman on this, chief economist and head of global economic research, J.P. Morgan Chase. Thanks for joining us today.
Thank you.
Any surprise in the decision to leave the rate unchanged or the reasons behind it?
No surprise at all there. Also, no surprise that there was a dissent in favor of easing by Governor Myron. I think there was something of a surprise in how the language in the statement evolved and moved relatively modestly towards a neutral bias, and then three FOMC members dissented. That was a surprise in making that dissent publicly. That's a very unusual thing to happen. It was a statement, I think, of more division among the committee. And of course, perhaps the most important thing in the press conference was Chair Powell's announcement that he was going to stay on. It wasn't clear what he was going to decide, and it wasn't clear he was going to announce it today. So that was all important news.
Yeah, and he's made it clear that he's going to stay on TBA on when he leaves, depending on what comes from the Department of Justice and others. So we don't know when he will choose to leave. Oil prices jumping again today. I saw Brent at 119. How long do you expect that impact to linger on inflation?
Well, as you say, oil is rising now. We don't know where it's going to go. We don't know when it's going to stop rising here. So I think the pass-through of oil prices directly to inflation is pretty quickly within a couple of months of when the prices go up. The big issue here really is about the geopolitics and whether the Strait of Hormuz will open. The more you keep it closed, the greater there is a risk here that supply shortfall combines with shifting in expectations about the conflict, and we start to see not only prices go up, but they go up in a nonlinear way. We think there's a genuine risk here, if the conflict isn't resolved, that we could have crude oil prices above $150 a barrel by mid-year.
Interesting. That is the highest number I've heard so far. You believe a majority of the members for the Fed will oppose lowering rates in the near future. So where do you expect rates to land by the end of the year? And we'll take the oil scenario as where it stands today.
Yeah, if we don't have that nonlinear spike in oil prices, I think what we're going to see is an economy that has a pretty healthy amount of momentum here be modestly weighed down by the oil price shock, and an economy that has elevated inflation have actually somewhat higher inflation, not just in energy, but in other products. I think if you get that with the other key view we have, which is that the labor market is going to start to recover here, there is no room for the Fed to ease policy this year. And in fact, I think it's more likely than not, although there's a lot of uncertainty around the energy story, but it's more likely than not that the next move from the Fed turning to 2027 is a hike.
Kevin Warsh's nomination moving ahead, as I'm sure you know, as we discussed Powell staying on as a governor. How do you think that'll affect Warsh's leadership? Powell made clear that he's going to be in the background. He doesn't want to be front and center, sort of as a former lead there. He wants to make sure he takes a back seat. But how do you think it'll affect Kevin Warsh and how he moves forward?
I don't think Powell staying there affects Kevin Warsh. I think Kevin Warsh will have to come onto a committee where he has been very critical of the way the Fed has operated on a number of levels. And in order for him to be effective, he has to mend fences and build consensus. That is not going to be, I think, affected materially by Powell staying, but it is going to be a difficult task. I think the other point to just keep in mind here, that what Powell is doing by staying, it's blocking the opening for President Trump to add another member to the FOMC committee. And I think that's probably the more important point, is he can stay till January of 2028. And his actions block a seat and probably encourage other members who might be thinking of leaving to stay on as well.
Warsh has said he will be independent. He's not going to be a sock puppet for Washington, for Donald Trump. Do you think that that is true? Do you think he will act more in sync with the White House?
Well, I think we have to start with the point that Warsh has one vote on a committee of 19 people. He does not have the ability to control monetary policy. And I don't think, in the end of the day, in order for him to be effective, it would be in his interest to really try to bully the committee in another direction. I think what Warsh is really going to operate on is the level of trying to alter the committee in terms of its communication policy, in terms of its balance sheet policy, in its relation with other arms of government on regulatory policies. And I don't think he's actually going to have much influence on monetary policy decisions for a macro environment that we think is not going to be conducive to cutting rates.
Talk to me about AI and how you think it fits in the future of the economy. There hasn't been a lot of discussion on that quite yet because of what's going on in Iran and other things. And I'm just wondering, in sync with Kevin Warsh, how you see that affecting perhaps the interest rates down the road.
Well, Kevin Warsh has taken a view, and he may push it as he gets onto the committee, that AI is going to lift productivity and therefore depress inflation, allowing some space for lower rates. I don't see that happening in the near term. I think the bigger impact from AI is going to be on boosting demand in the U.S. economy. And I think U.S. inflation is elevated already to begin with. So that is going to be an impulse which is probably going to keep inflation higher. I think there is a disruptive element of AI in the labor market, and it's going to be interesting to see how much that builds as we go forward for the next year or two. But I do think there's also a lot of new things that are going to be created by AI, and its net effect on jobs is going to be modest. To me, the big call here is that business sentiment has started to lift after the trade war hurt it last year. That is starting to improve the labor market. The question is whether this shock, which could be substantial, as we've noted, actually short circuits that lift that we think is starting to take hold.
Bruce Kasman, got to leave it there, but appreciate your time on the program, sir. Thanks for joining us.
Thank you.
When we come back, we'll have a look at what a steady inflation rate means for Canadians moving forward. Back in a moment. All right, we are going to take a listen to Tiff Macklem speaking today after deciding or announcing the decision that the rate will remain same for the Bank of Canada.
If there's significant new trade restrictions on Canada, that could have a material impact on the Canadian economy. We may need to cut to support growth. If oil prices go up, and particularly if they stay up, the risk that inflation becomes more persistent goes up, and there may need to be increases in the policy rate. And as we indicated, probably more than one, consecutive increases.
All right, what this means for the Canadian economy moving forward. Let's get Warren Lovely's look at that. He's with the National Bank Financial. Thanks for joining us today.
Yeah, my pleasure.
Let's talk about rising oil prices. The bank is essentially looking through it at this point. Is that the right move?
Well, looking through it, at least for the time being. I mean, I think the only thing that is steady here in the current environment is the interest rate setting that the Bank of Canada just announced. Everywhere else you look, there's volatility, uncertainty, and the bank is clearly trying to assess the balance of risks that the economy faces. We know there's trade uncertainty, but clearly the biggest issue that they're dealing with right now is the situation in the Middle East, the pop in oil prices, and how much inflation that might generate for Canada.
How long do you think they can look past it? At what point does it become pressure on longer-term inflation?
Well, I think you heard from the governor pretty clearly that if oil prices go higher or they stay high, and let's be clear, take a look at where oil is right now. It's well over $100 a barrel. Their ability to be patient diminishes the more persistent that oil price shock becomes. So there is some time that they have. There is some runway. There is slack in the economy. And importantly, core inflation in Canada is behaving pretty well. Headline inflation, we know, is getting battered by gasoline prices, but that slack, that weaker economy is holding down underlying inflation and gives them an ability to be a bit more patient.
The outlook pretty much the same for the Bank of Canada at this point. But as you mentioned, there are a lot of things swirling in the air, the price of oil being one of them, the trade talks and the review of CUSMA being another one. Do you think that one of these will, in the nearer term, affect the outlook in a negative way?
Well, imagine a devilish scenario, Morella, where we have a bad outcome on CUSMA discussions and an ongoing blockade in this strait and oil, remaining very, very high. Very hard to understand how the bank would react to that. I think what the bank is telling you is their base case forecast here, what they're effectively hoping, maybe assuming will play out, is that tariffs remain largely where they are, which is to say we avoid the nuclear option when it comes to Canada-U.S. trade negotiations, and oil prices gradually decline. And in that environment, they'll be much more comfortable with where interest rates are, and the moves will be more gradual, subtle. If we have just one bad event happen, oil prices go higher, stay higher, inflation spike, the governor's telling us consecutive hikes are what they'll be needing to do.
Okay, let's talk about employment as well and how it factors into these decisions. And I know it's not really under their purview, but it was mentioned today by the governor that unemployment is around 6.5% to 7%. Do you think that is something that does weigh on their decision, even though it's not under their purview per se?
Yeah, I think that's a great point, Morella. I mean, part of the characterization of the Canadian economy involves a close look at the labor market. And the bank's own word, and I tend to agree with this, is that the labor market is soft. And I think a lot of Canadians would probably agree with that, particularly if they've lost a job and are trying to look to find a new one. There's not a lot of hiring expectations out there. So I think that softness, weakness in the labor market is very much factoring into their thinking. I would imagine that the conditions in the housing market are also something that weighs on them. I mean, we have a very interest rate sensitive economy here in Canada. Housing's very important to this economy, and it's not doing well in Ontario, nationally, really, on average. So you've got those two factors, weak labor markets, soft housing markets, holding them back, weighing against a quick move to higher interest rates.
Are there lessons learned from the inflation period of COVID that could be applied here?
Well, one, you don't want to lose your institutional credibility, to be sure. So, and I think this is what central banks are grappling with globally, whether that's in the United States, over in Europe. You know, we had an argument back in 2022 that inflation would be transitory, and it ended up being quite problematic. So to some extent, that scarring from that earlier experience, is factoring into decisions here. The difference, of course, now versus 2022 is the Canadian economy is soft. It is weak. There is slack. So that, again, gives the bank a little bit more ability to look through at least this initial pop, not be too hasty, not overreact, particularly, again, Morella, when we consider that core inflation is actually behaving pretty well right now.
Warren, I've got to leave it there. I'm out of time. Thanks for your time. Warren Lovely's Managing Director, Chief Rates and Public Sector Strategist, National Bank Financial. Coming up next, the mega tech firms report earnings. Amazon, Meta, Alphabet, Microsoft, all coming up right after the bells. Here are the closing bells for the end of the trading day. At the Nasdaq, Z Squared ringing the bell. In New York, it's Gold Royalty ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. A down day for the markets today. The TSX dropping 265 points, or 0.8% today. Not a big move for the S&P 500, but the Nasdaq is up just a little bit, 9 points on the day. Let's get to the movers in Toronto. Here we start with CGI, which is down today 10.8%, losing $10.86 a share. Worst day it's had in a very long time, decades actually. Oh, no, not decades, but close. More on that with Stephanie Hughes in just a moment. Also down on earnings, Capital Power Core. It's down 7.6%, or $5.12, taking the share price to $62.37. Let's get to CN Rail. CN Rail is also down today, $9.45 a share, or 6%. Share price under $150 right now. Let's go to some of the winners today. And we're going to start with Go Easy. It is up 5.7%, or $1.82. So coming back off of credit concerns at $33.51. Strathcona Resources is also up 5.7%, or $2.22 today. And then Methanex closing up It's up 4.8% or $3.95, taking the share price to $86.65. Let's go to Bloomberg's equities reporter, Stephanie Hughes. She joins us now with more on what has been going on. Stephanie, let's start with Aecon. Share price getting to a price it hadn't seen in decades. Tell me more about that.
Yeah, that's right, Morella. So Aecon Group had been at the top of the TSX leaderboard earlier this morning before it was displaced by some of the names you just mentioned there, like GoEasy. But the shares did climb to 10% at its highest point today, which was its biggest move higher since March, and it brought the stock price to its highest level since 1990. That's been decades since we've seen this price at this level, and it feels like a distant memory these days. But that's entirely because of the results after the bell last night, where the construction and infrastructure firm reported a record backlog of $10.9 billion. Now, sometimes we associate backlog as being a bad thing, or think of that word as a bad thing, like if you have work backlog. But in the construction and infrastructure space, it is very much a good thing. It's illustrating a robust pipeline of demand for contracts and work, and can be pretty forward-looking for the demand of the business. So that's why people are really excited to see that Aecon has a big, strong backlog there. And it's also beating on segments like adjusted earnings, which posted a smaller loss compared to what analysts were expecting. And the revenue came ahead of the street's expectations. So it has a pretty good across-the-board showing for the most part. And the results were well received by the analyst community, including National Bank financial analyst Maxim Sychev, who said that the sizable beat and record backlog was thanks to revenues from the nuclear segment. So we're seeing some more strength there. That and the TD Cowen analyst team said before the market opened, they were expecting a positive reaction to shares, especially since Aecon's earnings before variables like interest, taxes, and other variables came ahead of expectations. And that's exactly what we saw today. It was leading the pack earlier today, but then got dethroned a bit, but still a very fantastic showing for Aecon Group, Morella.
All right, let's get to the flip side, which is CGI. What concerns do investors have there?
Yeah, it's interesting. Flip side for CGI, those shares fell as much as 16% at their lowest point today. And a lot of it has to do with AI concerns just weighing on the company. But that 16% drop, it was the worst trading day since the onset of the pandemic in March 2020 and dragged the share price down to its lowest level since November 2020. So it's been everything's kind of 2020 size and scope kind of pegged to that year. But what happened was that while CGI was able to match analyst estimates with most of its earnings, analysts didn't see the second quarter print as being robust enough to reverse the mostly AI-driven share price weakness over the past year. And that's exactly what TD Cowen's David Kwan said about the results, and also noting that there was a modest revenue miss and a negative pace of organic growth. He also flagged a 4% year-over-year decline in bookings just due to a weaker managed service demand, but did add in his comment there that the margins were at least fairly solid and did come ahead of what the analyst community was expecting. So it's largely some of the softness that we're seeing in the results, and coupled with the just negative sentiment about how AI is disrupting changing the game for CGI. That's really weighing on the stock here and made it the worst performer on the TSX for pretty much the entire trading day, Morella.
All right, we will leave it there. Thanks for the update, Stephanie. Appreciate it. All right, as promised, a bunch of the tech companies are reporting right now. We're going to start with Microsoft. So far on the year, shares are down 11%, weakest performance of the Mag 7. So let's go to the numbers and see what we can find. Revenue beating estimates for this company. Microsoft revenue for the third quarter coming in, earnings per share at $4.27. Microsoft revenue coming in at $82.89 billion. That is above the estimate at $81.46 billion. Microsoft, a third quarter cloud revenue coming at $54.5 billion, and the estimate had been $53.78 billion. Let's welcome to the conversation Felix Wang. He's Managing Director, Global Tech, Hedgeye Risk Management. Felix, thanks for joining us today. I know you've been looking at this stock in particular, which has lagged so far on the year. When you read the quick lines, what's standing out to you so far?
Hi, thank you for having me. It sounds like cloud growth for Azure was at 39% in constant currency. which is right where the bogey was for buy side and sell side. Now comes the fireworks, which will come probably around 6 o'clock, 6:10 Eastern time, where Amy Hood is going to talk about guidance for the June quarter. And this is where we are a little bit more cautious than the street. And we think, further deceleration for Azure could potentially come there. We think the bar is still relatively high. What we have been hearing is 38 to 39% growth for intelligent cloud on constant currency basis for that June quarter. So we'll see where we shake out, but I remain a little bit more cautious just because I'm not sure if Azure can really accelerate past this 40% mark that they experienced a couple of quarters ago.
Okay, what leads you to be a little bit more cautious in that outlook?
Sure, I think our thesis on Microsoft is twofold. One is on the infrastructure side, whether it's them basically losing a little bit of share to, say, GCP and AWS, partly because of demand, partly because of supply. I would just talk a little bit on the supply front. We have this hyperscaler CapEx data set that we look at for self-build pipeline, and Microsoft there has been lagging behind their peers. This tells me, that it's an indirect read on the demand part of Azure's business. Now, Azure's been kind of broken into two parts, right? Because first you have to support your internal projects like Copilot, and then you also need to market on the external cloud partners, external cloud customers. So Microsoft is in a tougher spot than their peers. So I think infrastructure-wise, their growth there is going to lag their peers. Now, the second part of our thesis is actually on the software part, and that's probably well understood by now. They're feeling pressure from the AI labs, Anthropic and Claude, and they're going to have to make a decision on whether to wrap the new products with the latest innovations from these AI labs or create something themselves. And they're so far behind on the foundation model themselves. It's going to be a tough task for Satya to catch up.
Okay, so capital expenditures coming in for the third quarter at $31.9 billion. The estimate had been $35.29 billion. So as you mentioned, you think they're underspending here?
Yeah, I think they're underspending. There's a lot of bottlenecks that's ongoing at the moment in data center infrastructure. We have a CPU crunch, we have a memory crunch, we have a substrate crunch. But again, I point to demand dynamics as well on the reason why they're probably a little bit more cautious on, potentially not overspending on CapEx. 31 does sound kind of low. We were looking for around 33, but below the market. And we'll see what Amy says for the June quarter. I expect a little bit of sequential pickup on the CapEx front for the June quarter, but still below expectations.
Let me ask you about the layoffs that they announced. They're not actually layoffs. I guess they're doing buyouts instead of layoffs. But how much of a lift could that provide for the company, or is it just not enough?
I don't really have an opinion on that. I think they're trying everything possible to put the right type of compensation packages for their senior officers there to produce the most productivity and to reduce costs in the face of AI disruption. So that's how I will put it.
Okay, let's talk a little bit more about Copilot for a moment, if you don't mind. They've put it into their Microsoft offerings, and as you were saying, it's not doing as well as some of the others out there. Do you think that they will continue to move it forward? Do you think it could catch up?
Yeah, that's a great question. I think the key part right now is what is the Copilot usage for Microsoft? Last quarter they said 3.5% of their Microsoft 365 users were using Copilot, or that's about 15 million seats. What is it this quarter? Do we see a substantial pickup in adoption for Copilot? Based on our research, we have shown that some of the small and medium businesses have actually seen a great reduction in Copilot renewal rates and also pricing. So we're wondering, again, 3.5% is going to go higher. but how much higher? 5%, 6%? Again, I'm looking forward to that guidance color from Amy when the conference call starts. I tend to be a little bit more cautious. I think of it as a code red moment for Copilot. And as you saw, they had a big shuffle of their Copilot team earlier this year. Management teams don't do big shuffles unless something was drastically wrong.
All right. We hope for some more clarity in the call. Felix Wang is with Hedgeye Risk. Thanks for joining us. Appreciate that.
Thank you.
Lots more to come from earnings from the Mag 7. We're going to be back with Alphabet and Meta in just a moment. Let's get to the next earnings results from Meta. Meta seeing second quarter revenue coming in at $58 billion to $61 billion. The estimate had been at $59.56 billion. They see their forward capex at $125 billion to $145 billion. It was $115 to $135, so that number has moved higher. Meta shares were sliding in the after hours on the earnings results so far. So let's start the discussion there with our guest today. Helping us break it down is Kim Forrest, founder and chief investment officer at Boca Capital Partners. Thanks for joining us. We know that Meta has been behind in the AI race and really is attempting to catch up. First, your take on the CapEx spend, which is moving up.
Sure. Well, I mean, that really says it all, that they are totally committed to making sure that they are one of the top players. And, well, spending money is good, but having a direction and the right team in place is a whole nother question. And I guess that's what analysts on the call are going to try to figure out is exactly what are they going to do with this money, right? Other than buy more compute.
Okay. Have they not laid clear their forward path? We know they've made cuts in an attempt to put some money towards that forward path, but you're saying they're not really being clear on where they're going with the money.
Sure. I mean, this has the flavor of the metaverse, where it was an idea that people would want to do this thing, and apparently that's gone by the by, right? And I just have to tell you, their platform doesn't necessarily, to me at least, and I'm an old software developer, I look at this kind of stuff about engagement, and, you know, they sell ads and they have all these people on there, which, you know, in the old days before computers, ad dollars went to also where people gathered, and that would be TV, newspapers, radio, that kind of thing. And I don't see, other than it's done on the internet, what the natural fit for Meta is with respect to AI. Google, I get it. You know, Amazon, they are providing the platform for people to develop on, and Microsoft has, you know, dual use. They have all of our data, and they are a natural place for development, again, because of their large platform. But Meta is a real head scratcher because nobody is buying, you know, compute off of them. And I don't know, but they want to win, so we'll see.
Okay, so really we're waiting to see what the forward initiative is for Meta. Let's get to Google, which is also reporting right now. We'll take a look at the numbers. This is Alphabet, of course, the parent company. The first quarter revenue coming in at $109.9 billion. The estimate had been under at 107.1. First quarter CapEx coming in at 35.67. The estimate had been 36.39, so an actual higher estimate than what they're reporting here. And first quarter Google Cloud revenue coming in at $20.03 billion, and that is better than the estimate of 18.41. So as you have spoken to, they've got a lot of information, but they've also got something usable that they're making money from already. What's your take on the numbers?
Right. Right. And I think that speaks a lot to what they're providing. They're providing something that people are willing to pay for. Hello, Meta, take a call, like figure this out.
Yep.
But I mean, and not only that, they're disciplined spenders. Everybody knows there was a whole lot of upward movement in semi and the whole compute field in this quarter. And, you know, $1 billion more doesn't seem that bad, right? Proportionally. So they are a discipline. Actually, it's less than $1 billion, but, you know, they spent a little bit more. And they're actually growing this business and establishing a business. So again, this is a company that understands that it has to not just build dreams, but actually monetize those dreams.
Talk to me about Gemini and how it stacks up against some of the other competitors in the space.
Sure. Well, it came out of the gate really strong. And I think Claude has stolen, and Anthropic has stolen everybody's oxygen in this area. Now, I don't think Meta was ever, Google was necessarily going to be the AI provider for code generation. So they're kind of safe, where it feels like they have a more consumer-oriented product, and consumers are willing to pay. Hip, hip, hooray for that. But Anthropic and these other non-public companies like OpenAI, and there's others, this is a very crowded space where people are trying to create out of whole cloth a whole new revenue stream and on services that people don't currently pay for. So there is a lot of speculative development going on. And for right now, for these, you know, what I've seen of earnings, it looks like Google is actually kind of a winner in this space.
Their tensor processing unit, are they gaining traction on that because of the demand being so high right now?
I think, and I mean, compute space or compute is a big issue, right? So if you're selling it, good luck with that. You know, you've got buyers.
I know we're early in the AI race and the AI space, but you just touched on this, and I'm wondering if you can expand for a moment. Are we beginning to see the winners and the losers in AI begin to shake out?
Well, we're beginning to see the end of the first mover is going to be the winner, right? Roll the clock back 2 years ago, it was game over. Why would anybody create any more chips ever? NVIDIA was your chip winner, right? And the same thing for OpenAI. Why even try? And I think that especially Anthropic, and I'm not going to get too deep into this, they're not necessarily all large language model driven and a direct technology competitor to OpenAI. But they have some nuances there. But what they're doing is they're using AI to satisfy customer demand. And I think that is going to mutate and change a lot between now and whenever these AI wars are over, which who knows when that's going to be.
Kim Forrest, good to have you. Thanks very much for sharing your time.
Thank you.
We still have Amazon to go. They're out with Q1 results. We'll have those when we come back. And last but certainly not least, Amazon reporting earnings. Shares have been up 25% just this month. It could be the best month the company has seen in about 4 years. So let's have a look at where they landed today. Amazon coming out with Q1 results and earnings per share coming in at $2.78. The estimate had been $1.68, so a big beat for them on that front. A net sales coming in at $181.52 billion. The estimate had been $177.23, so a nice big beat for them there as well. Second quarter net sales, so this is a look ahead, coming in at $194 billion to $199, and the estimate had been well under that at $189.15. Here's a key metric: Amazon's web services net sales, $37.59 billion. The estimate had been at $36.68 billion, so that is something we're looking at there. We'll digest those in a couple of minutes. Planning for your child's future has never been more complicated. In the past, it meant setting money aside for an RESP and watching it grow. But a new survey says many new parents aren't in a position to do that, and many are relying on their parents for help. Here's CTV's Heather Wright.
Isabel. With 3 kids in university at the same time, Brad Nussbaum knows just how expensive post-secondary tuition can be.
It was sort of like childcare, right? Having 3 kids in childcare at the same time, it's expensive. School's expensive.
Brad and his wife made a deal with their kids. They'd pay for tuition, the kids pay for living expenses. Registered education savings plans help cover most, and they got creative to take care of the rest.
There's a lot of scholarship that don't go claim. So we had the kids apply for every scholarship that we could find.
But as post-secondary tuition rises, more families say they might not be able to fully pay for their child's post-secondary education. According to a survey from Embark and Angus Reid, just 33% of parents say they can cover their kids' tuition. 27% say they won't be able to, while 26% expect it will be financially difficult.
Despite the large number of new parents today are financially planning and budgeting for the future of their children, there's not a lot of confidence that they can afford it.
In its early parent readiness report, Embark, an education savings and planning company, says there is significant concern among new and expectant parents when it comes to the cost of raising children. More than half say they are only somewhat financially prepared, while more than 1 in 3 say they've received financial help from family members. The advice from both financial planners and parents like Brad is to plan early to have as much time to save as possible.
We did a lot of things for our kids to get them to where they are.
With tuition, rent, and other living expenses, post-secondary education in Canada can exceed $30,000 a year, a number that keeps rising. Heather Wright, CTV News, Burlington, Ontario.
For the majority of Canadians, the rising cost of living is the biggest issue they want the federal government to tackle. CTV senior correspondent Judy Trin hit the streets of Ottawa to see if the fiscal measures outlined in the spring economic update met the mark.
On this field trip to Parliament Hill, the students worry about what the future holds and if the Liberals' spring economic update has anything for them.
I'm concerned about jobs in the future because we live in Ontario, right? Most students right now are thinking about how are they going to afford post-secondary. We're talking about OSAP cuts. We're talking about getting jobs for youth. We're in Ontario. We have one of the highest unemployment rates in the country for youth.
In June, lower-income families will receive a one-time grocery top-up, but some Canadians want the federal government to cap prices on basic items.
Our basic needs, so gas and groceries, I think those, anything that can be done to stabilize the pricing there, I think would help.
The federal fuel surtax has been temporarily suspended, saving consumers 10 cents a liter on gas and 4 cents per liter on diesel. But others want cheaper cars and are calling on the Prime Minister to bring more Chinese EVs to Canada.
Having less expensive automobiles in Canada will actually be better for consumers as a whole because they'll be able to afford them more.
Then there are calls for more fiscal action.
The more you bring down the deficit, the less the interest you pay, the more money you're going to have to put it in places where it needs to be put.
The deficit was reduced by $11 billion last year. But to put it into perspective, that's less than 1% of Canada's total debt level, which stands at $1.44 trillion. Judy Trin, CTV News, Ottawa.
Coming up next, federal government reported a reduced deficit in the spring economic update. We'll have a second look at that when we come back. The federal government shared its economic update on Tuesday, a deficit lower of $11.5 billion. But the spending in the agenda means the money that's coming in is likely going to go out pretty quickly. Let's go to Vinayak Seshasai, Executive Vice President, Portfolio Manager at PIMCO, to talk about this. Vinayak, thanks for joining us today. Are you surprised by the strength of the economy with revenue being up?
Not really. This is something that we certainly had expected. When you look at the total revenue projections for 26 and 27, well, first of all, I think we've seen a material increase in oil prices. So pegging oil prices at plus 100 and above, certainly Canada as a fiscal entity benefits over a longer period of time from royalties and income related to that. Aside from that, we've also seen, green shoots in several other parts of the economy. And I would reiterate, the economy is coming off of a very weak base. So we had 2 or 3 years of relatively weak growth. So starting from a low base, we're not surprised that the economy seems to be doing better and will likely continue to get better.
When you say you're seeing some green shoots, is that sort of business sentiment that's changing?
Well, a few things. One, we do think that as we get closer to the deadline for the CUSMA renewal, our expectation is that that will go off without any serious change to the current state of play with regards to tariffs. So we do think tariff-free trade between U.S. and Canada will remain in force. That is likely to take a little bit more uncertainty and give a little support to businesses. Second, we are seeing several initiatives within the economic plan that makes allowances to support businesses in a more meaningful way. There's been $25 billion set aside over 3 years for a new fund to support and go alongside private capital into new infrastructure investments. And then last but not least, we are also seeing slowly but steadily the housing market starting to make a little bit of a bottom here, and we do expect that it will stabilize and slowly start to strengthen. So all those are the key factors that I would point to when I say we are starting to see an economy where the slack is actually being used up. So we've gone from a peak of 7.1% unemployment to 6.7 now, and we are likely to see that continue to come down.
Okay, so you feel pretty, I'm going to use the word optimistic about the CUSMA review not adding any tariffs or further pressure on the Canadian economy?
We do. We just, when we look at the state of play in the U.S., first and foremost, we've got the midterms elections coming up, and Republicans require all the support that they can get. We don't think there's much interest in the House or the Senate to support, the U.S. pulling out of CUSMA. Canada continues to be the #1 export destination for 36 U.S. states. So it's incredibly important as a trading partner. Moreover, with the war in Iran putting so much upward pressure on commodity prices, I think now more than ever, the United States needs Canada as its partner, as one of the biggest suppliers of oil to actually be on good trading terms. So we feel that the odds of the U.S. exiting CUSMA this year remain quite low.
Okay, let me talk to you about some of the new spending that was announced yesterday. Part of that will go to skills training. As we change in society in a number of different ways, the infrastructure build-out will be different. We have AI build-out also going on. I'm wondering what you think of that investment into the skills training part of it.
At this point, I would say having not really seen any impact, we do have to be careful about extrapolating that in a very big way. One of the issues with Canada always has been that the initial outlays and the plans are very aggressive and ambitious. However, the execution sometimes takes more time, or the process actually ends up getting elongated. So what we would say is that ultimately kind of the devil lies in the detail, and it's the execution that matters. So the faster these funds are able to be appropriated and put to work into actual programs that are able to sign up, a lot of young people or people looking to reskill, and more importantly, they need to be, enrolled into programs that are applicable for the economy of the next 10 or 15 or 20 years. And I think there's a lot of nuance to that. So at this point, we are not really baking in any material change in the growth profile of the economy as a result of those programs.
Okay, but you are positive about the Sovereign Wealth Fund. And I'm asking because many are looking for clarity there. Not a lot of that came yesterday as well. People want to know how it's going to work. Retail investors are to be allowed to put some money in, but it's not sure where the initial capital is coming from.
Yeah, and I think that's where ultimately the goal of the government is to crowd in private capital. As you know, Canada is one of these destinations that's seen very, very positive, not only by domestic investors, but also by international investors. We've got a AAA rating, we've got very low and stable inflation, and we are very rich in a whole range of resources, whether it's hydrocarbons, rare earths, you name it. All of the things that the world is really short on and is looking for right now, they exist right here in Canada. So I think the process of prudently and responsibly extracting those resources is something that can greatly contribute to national wealth and prosperity. But I think what the government is looking to do is use this as a seed fund and then probably attract more money from private investors who are likely to be more incentivized to invest if they feel like they're going alongside the central government or the federal government on these projects. They're likely to have, more confidence that the things that need to be done will actually get done in a more timely fashion.
Vinayak, I've got to leave it there, sir, but appreciate your time. Vinayak is the Executive Vice President and Portfolio Manager, PIMCO. Up next, stocks of Bill Ackman's Pershing Square slid on its market debut. An interview with Ackman in a moment. Pershing Square has gone public after years of social media hyping about building an empire modeled on Warren Buffett. And even after raising $5 billion for his vision, the hedge fund billionaire faces another test. Our colleagues at Bloomberg sat down with Bill Ackman, founder and CEO of Pershing Square Capital Management.
Actually, we think it's a very good time to put the capital to work, and we invest in the most liquid companies in the world. So it's weeks, not months.
So it's weeks. But there's this question. So some of the companies that you own in your other portfolio, for example, Uber, Meta, they've had a good run, and you're already very long them. So the question might arise, is now the right time to be doubling down?
Actually, I think the companies you mentioned are very cheap stocks today. Interestingly, some of the best businesses in the world are trading at the lowest multiples they've traded at, in some cases, in history. Actually, those multiples bottomed maybe 2 weeks ago, so we're a little bit off the all-time bottom, but very bullish on the economy, and there are some amazing businesses available at really cheap prices. This will be kind of a continuation of what we're doing now, so we're going to just add to existing positions, which will give us more ownership. And in our strategy, we like to be a big shareholder.
As you said, very liquid stocks. So the market is there. What about for like a Fannie or Freddie, where they trade OTC? How does that work? How do you dive back in without moving the market?
We're going to be very thoughtful about the way we deploy the capital. We're not going to tell anyone on TV what we're going to do.
I see. You don't want to front run anyone. Yes. Perhaps a wise decision. And look, you've discussed, you were talking about it earlier this morning on CNBC, that closed-end funds, they trade at a discount to NAV. That's not a surprise. So what does success look like in this scenario? Is for example, like a 10% discount okay? So
I want to give you a new construct to think about.
Please.
Okay, so there's hundreds of closed-end funds, but they're a very different animal for what we're doing here. We're adopting the closed-end structure, the legal structure, the corporate structure, because it's the most flexible and most tax-efficient corporate structure in America. It's never been used for the purpose that we're going to use it for. But if you think about our business as a business, think of us as an investment holding company. It's a business that's earned a 19% return on equity for the last 22 years. If you look in Bloomberg, someone should do a search real time. Find me a business that's earned 19% on equity for the last 22 years that trades for less than 2 times book value. And we're taking the company public at book value. So we think that's going to be a cheap price. Now, the nature of IPOs are such that in the first couple of days, I can't tell you exactly what's going to happen. But over time, we're going to compound this book value, or NAV, as some people call it, if we do anything like what we've done in the past, a high rate over time, and it's going to compound and it's going to grow. And we're going to run it like a real company. Closed-end funds are kind of a backwater. No one actually wakes up and gets excited about investing in a traditional closed-end IPO. They're kind of generic. You don't know who runs them. I bet Bloomberg's never even run a story. And they don't hold conference calls with their shareholders. They don't have particularly distinguished boards of directors. If this were a C Corp, no one would be asking me whether it should trade at a discount or not.
Sure.
But you can't deploy our strategy in a C Corp, which is why we've chosen this structure. And it's more tax efficient than a C Corp. It's a flow-through entity for tax purposes. So more tax efficient. And then we fix the things that are problematic about closed-end funds. So it's the lowest cost compensation for a management firm like us to manage this pool of assets. In fact, we charge our other funds incentive fees. We don't do so here. We're not permitted to do so here. So it's the lowest cost version of Pershing Square. You take our record over the last 8 years since we've had permanent capital, it's been a 24.9% return. That's a very high rate of return relative even to the stock market, which did about 10% per annum not as well. So it's a liquid way to invest in Pershing Square at very low cost, and we're going to build the value of this entity over decades.
Well, and I know you've said before.
Now, by the way, that's just one of the companies we took public today.
That's true. And you have Pershing Square, the holding company, the holdco, and you also have ambitions to maybe list more funds. How quickly can you ramp up AUM? I know you said just by the nature of what you're doing, by compounding, that you could get to $1 trillion in 20 years. Do you have your own internal targets you're thinking of?
So the first priority is to compound at a high rate for a long period of time. That's a much easier thing than doing an IPO. Right? IPOs can take management time and attention. So we're going to focus on investing. We're going to focus on getting our Universal Music deal done. We're going to focus on helping the administration figure out Fannie and Freddie. We're going to help our company succeed. And the beauty of that is it grows our AUM. And the beauty of this, of Pershing Square, the management company, or some people call it the GP, is it grows with compounding. Other asset management firms generally only grow with raising money. If you look at a KKR or the other sort of alternative asset management firms, if they stop raising money, they shrink because they're constantly sending money back to their investors. As they sell assets, they send money back. In our model, we build off a base, and if we're up 20%, the assets will grow about 20%. And so that's a very fast rate of growth without the need to raise any additional capital.
Can you rival the size of those? I mean, I know it's a very different model, but do you see yourself growing to a size of a Blackstone, of an Apollo?
Over time, for sure. And that was the point I was making. We'll have 25, today, post the closing of this IPO, we'll have 25 to 26 billion of fee-paying assets.
Does the way you invest need to change then? Because these are huge platforms that have many different types of assets they invest in.
The beauty of our strategy, we invest in the largest companies in the world, kind of large cap, mega cap companies, mostly based here. We're tiny in the context of the capital markets. We manage the money in a concentrated fashion, but with 25 billion of capital, a couple $1 billion per investment, that's small in the context of the market we invest in.
By the way, and you know, this is quite unique. As you point out, there's not really another structure that's listed like this. How are you thinking about it, though, in terms of having a listed structure, both Pershing Square and PSUS, that it is centered around you and your very small team, which I know is you see that as a benefit too. Does it change how you communicate? Does it change what you put on social media?
Yes.
Because it could impact share prices?
It does.
Well, I guess legally is one question, but beyond that.
Well, actually, believe it or not, I've been very constrained on social media. Maybe you find that a surprise. But with respect to talking about Pershing Square, there are a lot of limitations up until this moment in time. Now we have an SEC-registered entity. Our existing offshore closed-end fund, we're not allowed to talk about it in America. Right. And this is where I spend the vast majority of my time, so it's something we can't talk about. The beauty of this entity is we're going to be able to, we make an investment. We can say today we bought a 10% stake in company ABC. Here's why we own it, ticker symbol PSUS, and investors. We can keep very close touch with our shareholders. And one thing that Elon Musk has done very well over a long period of time is he built a base of followers that were very supportive of Tesla over time, reduced the cost of Tesla stock, and that's been a competitive advantage that Tesla's had over time. We have already a very large base of followers in the capital markets. They haven't had a way to invest with us until now.
Bill Ackman is the founder and CEO of Pershing Square Capital Management. Coming up, Starbucks delivered a strong quarterly beat, but the key question remains unanswered. We'll speak to an analyst who has a sell rating on the stock. Back in a moment. Over the past year, Starbucks' new CEO has poured millions of dollars into turning around the coffee chain, and the results did show up in a strong quarterly earnings beat. But will the turnaround last, and can margins continue to expand? We found that out from Jacob Aiken-Phillips, Director of Consumer Research at Melius Research.
Management definitely deserves some credit here. They've turned around the store operationally. They've invested a lot back in labor, and they really drove a big traffic beat versus what the street was expecting. Although I will say that last year, they had a negative 4% traffic. So it's all an easy comp, but it's definitely a signal that the turnaround is happening. That said, U.S. margins did go down, and there will be continued pressure on U.S. margins. The consolidated operating margin increase was partially due to the deconsolidation of the China entity. And so I just need to see sustained traffic recovery, because to get to their long-term algo or to beat it, they're going to have to comp over this next year and the year after that and the year after that.
Where do you see the pressure on the margins in the U.S. coming from?
It was like probably mainly coffee. Labor was a big part, and then coffee inflation, where although spot prices have come down a bit, the way Starbucks hedges, they're seeing the most pressure in the first half of this year.
And let's talk a little bit. What have they done? You commented on it, but what were some of the biggest things that you see that you actually like about it?
Yeah, I mean, the back to Starbucks plan, the putting labor back in stores, getting service times down, really adding a queuing system so that mobile orders happen at the right time, and so you're not waiting for people to make mobile orders while you're actually in the store waiting. All things like that, although it does weigh on the operating margin, is really beneficial to the store from an operation standpoint, and the guests are seeing it. I'm more likely to go back if I'm in and out in 4 minutes and I have a really good experience with the barista.
Okay, so that's all right. So that's one of the big things. And I mean, international markets, they were all returning to positive comparable store sales for the first time in 9 quarters. That's got to be a positive for them.
Oh, definitely, definitely. I mean, the international story has never been, in my view, like I never questioned it. The international unit growth and then eventually getting back to positive transaction growth and sustaining that is something that I could easily see. I've been more focused on the U.S., North America, and particularly the U.S. business, because that's the foundation. And if the brand equity declines there, then you would see impact more broadly across the globe.
And now you mentioned with China, go a little deeper with China. Where's Starbucks heading with that? What's your concerns?
Yeah, I mean, there's a lot of competition in China. So they found a good operator, good local operator, which I think they needed, because there are some local intricacies that is in China that's not present in the U.S. It's a huge delivery market. There's like lots of local competition. Walk-in is a big competitor, and they're very convenience focused over there. But with the new local operator, I can see them getting back to unit growth. It's just going to take over a multiple year horizon, which is fine because they monetized it.
And as we look forward, the guidance, what was there anything you felt was missing, or is there anything you would like to have seen stronger on top of what you mentioned already?
No, I mean, I think for the year, the guidance is probably maybe, I wouldn't say conservative, but like probably on point. But they did not withhold, but they maintained the 2028 outlook, the $4 EPS. And I think that the general consensus now is that that's probably like conservative. But like, you asked why I'm sell on it. If they even beat the $4 EPS 2028, let's say they get to 5. Mm-hmm. At the current price, you have to put 25 to 30x PE multiple on a 2-year out number just to justify that. And I think there are better opportunities across my space and across the broader landscape at a much more compelling multiple.
What are some of the better options, you think?
So Yum just reported this morning, Taco Bell's outperforming the entire QSR market, 8% comp. They have an excellent technology system, Bite by Yum, that is layering on AI, and it works across all their brands, and they're just expanding greatly. I also really like Dutch Bros. It's a coffee competitor to Starbucks, but it's more on the convenience side, and they actually already have the energy lineup. I think like half or even more than half of their sales are energy drinks and not coffee.
Could you see any M&As in that sector at all with that?
M&As in restaurant overall?
Starbucks looking at a couple of those competitors that you just mentioned?
I think that Dutch Bros, it would have to be a very high price and for Dutch Bros to be willing to sell, so I don't see that happening. But also, it's just a cultural clash. Well, not a clash, but like
different.
Starbucks is all about back to the third place, making a nice coffee house. Dutch Bros is all about convenience, drive-through.
Jacob Aiken-Phillips, Director of Consumer Research, Melius Research. A final look at where we ended the day today, Bay Street and Wall Street. But we're going to show you big tech and the winner today in earnings in a moment. The TSX down 265 points, or 0.8%. Now we're going to show you Alphabet, which seems to be the winner in the big tech results earnings that came out today. Remember, Meta, Microsoft, and Amazon also reporting today. So their revenue and their profit beat projections. They had strong growth in cloud computing, signaling the giant's unprecedented investment in AI are finally beginning to pay off. Once again, that is for Alphabet. That does it for the close today. Thanks for joining us. We'll see you tomorrow.